You look calm.
Yeah, I think
Are you calm?
Yeah, I mean, it's certainly been a very busy week. We're watching everything very closely, but this kind of market volatility that we're seeing is actually what you'd expect in normal market scenarios. Since 1980 to present, the average intra-year decline in the S&P 500 is 14%. And more years than most, the end-of-year result, the full annualized return, is positive. So this happened in 2016. 2017 was a lot calmer, but what we're going into now is actually normal market behavior. Volatility should have been higher in the past year and a half, and that's what we're starting to see.
We've heard all sorts of phrases: healthy correction, buy the dip, fill your boots. Haven't heard that one. Should we fill our boots?
No, I'm not necessarily saying that. I think there's times when this is presenting certain opportunities, whether it's in the specific types of sectors and stocks that we see doing better. But if we know that earnings per share, EPS growth rates are expected to be positive in every market, Japan, US, Europe, and UK, particularly the US actually, where just in the last month, EPS upgrades have been huge. We've seen it go from around 10% to now closer to 18 to 20% EPS growth expected. That's when fundamentals are telling us the equity market should do well.
So, Nandini, where specifically are you looking then? Where are you advising clients to look? Many of them must be calling you up and saying this is the best opportunity we've had in years.
That's a great question to ask at this time. And when you look at some of the key market movers, we split definitely the equity market, which we think is being a bit more spooked than it should be, versus the bond market, which is actually pricing in what we think are appropriate monetary policy changes. The Fed is going to be rising interest rates 3 or 4 times this year. We've already seen just in the last week the interest rate curve in the U.S. become a bit steeper. That bodes well for financials in the U.S., who could also benefit from deregulation, certainly benefit from the tax reform change of lower tax rates in the U.S. So that's an area we would like in the U.S. equity market. We'd also think about broader themes around the world that are more than just contained within the past week or the past few months, is things like technology stocks, and not just the big names that we see in the U.S., but broad parts of the supply chain in technology that are interesting. So who's making the chips and the hardware and even the software that's going to be implemented in all these exciting stories of driverless cars or facial recognition. So those are the broader long-term themes we like across the world. But overall, we are actually positive on most equity markets, given the global synchronized recovery we've been seeing in the hard data.